having access to raw pricing, you know exactly, what the company's making, what you're making, and it just makes the loan officers feel more comfortable.
Mm.
The borrowers and the agents aren't really involved in that process.
Okay.
It's more of a loan officer thing, but again, you just know where you stand. And obviously you can see the rates. You have more control over what rates you're offering. You've got all the programs to choose from. So whether you're doing a non-QM loan that's a bank statement product or a stated income product or a DSCR loan, you're getting the same compensation that you would on a loan that's through Fannie or Freddie or FHA or VA, whatever the case may be. And in most cases, at a retail bank, when you're brokering a loan out, you get paid less.
Mm.
If you need a price exception to compete with a broker, you're having to take reduced compensation. That doesn't exist on the side of the fence. There are no price exceptions. There are no, reduced compensation models, which quite frankly, there's a thing going around right now where, compliance, like, is it compliant for a loan officer to take reduced compensation on one loan transaction and not another? It's a loan officer comp rule conflict that I think is going to become, a more defined problem over the next year or two. And we'll see how that plays out. But we don't have that issue on our side because the loan officers aren't doing price exceptions because, quite frankly, they don't need to. Their pricing is already sharp and doesn't need to be improved upon.
Hmm. Wow. And again, I appreciate that explanation. And I know so many other individuals that are tuning into this, especially loan officer specific, they appreciate that. And I
Well,
think,
and if you're a loan officer and you've been in the retail model your whole career, you just don't know any better. And so, my suggestion to loan officers that are working for retail banks is to have a conversation with the company that is a correspondent lender.